Good morning, everybody. We're at the beginning of August, and this is kind of a hot topic here that we've recently been hearing from our carriers. So to kind of get things started, my name is Andrew Bazan. I head up the product and marketing here at Simplex Group, company that's been involved with our trucking partners for about 25 years. In fact, we're celebrating our 25th anniversary this year of being in business. We thank first and foremost, any carrier partners of ours who are watching at the moment, who are current clients of ours, wouldn't be here without you, and really appreciate your support as always. So we're going to get started on a couple of things that have driven the market conversation towards what's happening with trucking. We've been hearing a lot of headlines of the trucks are doing great, spot rates are up, money is great. But then on the other side, we've been hearing, hey, yeah, but diesel's also up. This is what's going on. And a lot of trucks are actually exiting. And so, purely said, the trucks that left the market aren't coming back. And this isn't just for this year. This has been an ongoing for the last 12 months or so. And over the last 46 months, we've had a shipper-led market, right? It's been the shippers making the call. And that has since flipped to a more carrier-friendly market. And we're going to get into that as to what kind of drove that over. So let's talk about two core signals that have been happening so far and that we saw in the summer recently up through the end of July, right? So for the first time since February 2022, dry van spot rates overtook its contract rates. When that happens, it means shippers are willing to pay a premium for their spot rates, for their loads, right? And so when that happens, it means carriers are starting to become a little bit more in charge. The other thing that kind of validates this or confirms it is tender rejections, quite literally putting the carriers in the driving spot, right? So if carriers are now rejecting tender because they have better opportunity, it's kind of confirming that there's something going on in the market. The carriers now are being able to put a little bit more of a price on the loads that are coming in. So tender rejections have been its highest in the last 4 years. Spot rates are taking a very big high peak. And let's get into that a little bit, right? But all that being said, there's one big central tension here, one big central point that needs to be talked about, is being talked about. And that's not necessarily that the boom that we're seeing or this increase that we're seeing is driven by demand, right? Demand is when folks say, hey, we have so much of this stuff that needs to be shipped out. In fact, demand has, for the most part, has been relatively flat across multiple industries and sectors. What's really driving this is a supply side, driven mostly by regulation. And so the current state, July, genuine peak. July came in, we saw produce season up, Salinas was doing great, Central California doing great with its produce season for reefers. So how did the month end? And what's going on with early August so far? So if we take a look here really quickly, this is dry van spot rates. So year to date, we're looking here from January through the end of July here. There's been a big upward trend, right? So if you're looking at 2025, the difference between spot rates for dry vans, very, very big. Since January, there's been about an 8% increase. The peak over 2025 really was in June, July at about almost 50%. So that's looking great. And the majority of dry van you would think is, I don't know, maybe it's demand. Demand for it itself, once again, has been relatively flat at about 1% increase in demand. So really what has been driving dry van spot rates out of the three biggest ones between reefers and flatbeds alone has been that regulation that we're going to talk about in a minute. So that's dry van. You guys are looking up. For those that drive it, you guys are looking up. Same thing with reefers. Reefers also saw a little bit more than dry van, about 10% since the beginning of the year it's increased, and around 40% it's sticking to right now, year over year. Its peak was about 43%. Once again, June and July, that summer peak was fantastic across the board for all three. And then if we take a look at flatbed, Flatbed is having its moment. Flatbed has really been the darling of this industry so far, year to date. Now, we did see a bit of a dip in February. However, since January, it's nearly about 17% growth. And again, hitting in that between 40 to 43% year over year. Let's dive in a little bit into flatbed, though. Flatbed is having its moment. If we're talking about drive-in and reefers really being having its spot rates increase mostly due to regulation, flatbed is slightly of a different story. The spot rates for flatbed are actually mostly driven by demand. Now, historically, flatbeds, when housing and home building does really well and it's booming, it's great. When the residential market is booming, it's great for flatbed. How is housing and home building looking like right now? It's actually pretty flat. It's stalled at the moment. Home prices are low. They're not really building a lot of single family homes right now. So then why is flatbed going up so high? Where is that demand? AI, that ChatGPT that we all love, that Claude, that Perplexity, all those AI data centers need to be built because there's a ton of demand and consumer demand for it, right? So it's been an extraordinary year for flatbed, mostly driven by AI. It's been about 24 weeks. It got cut in about June, where flatbed saw an increase in spot rates since October 2025. Now, once again, these AI data centers need to be built. It needs to have infrastructure. Fun fact, for each gigawatt of a new data center, the capacity requires around 100,000 truckloads of concrete, steel, transformers, generators. Who drives that? Flatbeds do, right? In addition to that, like we mentioned, residential housing not having its moment right now, but non-residential construction, commercial is mostly utility, energy infrastructure. You've got your solar, you've got your water. What's going on with that though? It's requirement for cooling from those same AI data centers. So in a way, AI is also affecting the non-residentials. Domestic steel. Domestic steel, typically, we want it to be the very, very happy is around 80 over 70%. You're pretty good. Domestic steel, as of early August, is around almost 79%. So again, steel being moved around, mostly for AI data centers, right? Commercial. So what does all of this mean? It means flatbed is not only positioning itself for a true surge due to demand, but there's one more thing that's coming up, and that's defense production. So some of you have probably heard about the $1.5 trillion bill looking for 2027 for the defense proposed bill. Now, what does that mean? Flatbed tends to move those missiles, that machinery, that ammunition. So the Defense Department with this new bill is going to require a lot more of these trucks to be able to drive those things around because the majority of that bill is going to be for weapons, munitions. So to say that flatbed is going to be having, let's say, a two-pillar tailwind, right, with AI and the defense coming up, if you're going to bet on one of these three, you're very good, and you're probably pretty good to bet on flatbed coming up for the next couple of years, that it should be pretty steady. That's July. So here's what just happened in August. So in August, we're seeing about the fifth week of a little bit of a decline across the board for spot rates. It's not anything too alarming. Some of these are between 1 cent or 2 cents, right? And then DAT will show the actual August ones mid-September. So right now you're kind of looking at the rates excluding fuel. You're looking at the line haul rates. Dry van sitting around 232, reefer at 265, flatbed 283. So a little bit under that 3, but again, this is the line haul. It is excluding the fuel surcharge. In August, we also saw spot rates overall decreasing about 17%, coming off of its peak of the 4th of July. And then tender rejections, like we kind of talked about, down a bit, maybe 4%, but it's still above a really good baseline that you want to be at, where it's still saying and marking the fact that carriers are being able to choose their loads right now. Now, one big takeaway, yes, August is going a little bit of a decline-ish, but down from record highs does not mean this is a weakening market necessarily. This is a market reset. There's been a ton of overcapacity, which we'll get to in a minute, as promised. This is the market correcting itself to a new normal, we hope, right? Now, besides the spot rates, what's kind of pointing to this new normal? So the PMI index just came out at the end of July. This is your purchasing manager's index, right? This is what tells you what orders are coming in into the factories, what our manufacturing look like. Why is this important? Because once manufacturers deliver these orders, it's trucks that move these around, right? So the PMI has been the highest in its 4-year. It ended at 55.6% at the end of July, with the commentary of these purchasing managers saying that inventory is almost too low. So factories need to produce more, which is great, right? We want to be at about that over 50%. Anything under 42, you're looking at a bad GDP. You obviously don't want to be there. We're not anywhere near there. Pair that with the tonnage of 114, which is about 14% over where it should be. And you're looking at a very healthy range for trucks, for what is needed for truckloads. So since August 8th, that demand that's kind of been falling that we're talking about has started to see a little bit of a peak. Again, mostly due to this manufacturing that's coming out. Now, August, back to school season. Typically, the peak retail season is between October to December, as we all know. It is starting to get a little bit of an earlier kick this year. Usually, you don't see it so much. You see it a little bit, but not so much with back to school. However, this year we did see some early demand signals, which is already underway. In addition to possibly Halloween, there's been some back and forth on how Halloween has recently, over the years, become something that more retailers have started to stock for, right? And so September and October, you're looking at your Amazon Prime days. That's a really big time for the industry right now. So inventory is starting to front load. Retailers are starting to stock up for this upcoming holiday season. And then you're looking at your highest intensity time during November and December. So this summer cool down that you're seeing here between July and August is probably going to start to pick up a little bit more during the end of August, the beginning of September. And it's, again, don't take this necessarily, this cool down, as something that's a warning sign. It's typically kind of the pattern for the industry here. So all that sounds really great. And you might be wondering, so if all this sounds really, really great, why are we saying that the trucks are leaving the market? Well, because it's true. And once again, a lot of these spot rates that we're talking about, a lot of this money that's coming out is not necessarily because of the demand, albeit flatbed, like we talked about, is a little bit of a different story. The real driver here, the big story here as to why we keep saying, hey, these trucks aren't coming back. This spot rate is mostly supply driven, right? Is because of regulation. The churn is real, guys. So we've all heard, we've been consistently hearing over the last year, FMCSA Administrator Derek Bars, the FMCSA itself, is taking compliance, too hard. We want those bad actors off the road. We know you guys also don't want to be hiring the bad drivers, quote unquote, right? Guys that could probably potentially get you in trouble. So the FMCSA has done a lot that we've all heard about in regulations, with the English proficiency, with the ELD revocations. That's really kind of been stabilizing, if you will, a little bit of this trucking capacity. So what did Q1 look like? So in Q1, interestingly enough, and this was right before the Iran war, right? When the Iran war, diesel prices went up a little bit, kind of started to scare some people off. But in Q1, where you started to see those spot rates really going up, you saw a lot of carriers entering into the industry, which was great. Iran war came out, diesel prices started to go down, diesel prices started to go up, and trucks started to go down. So Q2 came in, and the new authority applications actually, even though they surged, the revocations started to actually surpass that. Therefore, at the end, halfway through this year, you're looking at a clean cost. There's no one way or the other. We can't say that there's more people here, more people coming in versus more people leaving out. You're looking at a clean kind of cut. You can't see it both ways, all right? But these guys who are being forced out are likely not coming back. And that's due to these three enforcement waves that hit Q2, Q3 at about the same time. Now, you've been hearing a lot about this, right? The non-domiciled rule that came in. This is going to restrict and make eligibility for renewal a lot harder for those non-domiciled CDLs. This is affecting the projection. Okay, the projection is that it's going to affect about 97% of those 200,000 non-domiciled CDL drivers. That's a lot. All right. We have the ELD crackdown, like we mentioned. I think April and June were the only 2 months year to date so far that did not see ELD revocations. From there, January, February, March, during the summer, there were double-digit revocations each month coming up. Okay, so FMCSA is serious. If your ELD cannot pass, does not look safe, it's not going to add you to the list. It's actually going to remove you. And now you've got 60 days to replace it. And then probably one of the bigger stories out here was the SCOTUS ruling in the Caribe Transport versus Montgomery, mostly affecting brokers like C.H. Robinson, who was a part of that case, who then later got hit once again in July in Dallas County. The bigger ruling, we can go into details, but this is an illegal show. But what came out of it is that brokers now can be sued for hiring unsafe drivers. This is one of the bigger pushes of exits that was coming in after this ruling. Insurance exits. A lot of this came because now brokers aren't going to want to hire somebody that could potentially put them into a liable situation, right? And especially after C.H. Robinson's hit in July over that multi-tragedy personal injury accident that happened in Dallas, Texas, where they came out with a $604 million verdict that they had to pay up, right? So these three things kind of all took a big, when it rains, it pours. It took a big hit. You started to see the trucks really exiting by pressures from insurance, by pressures from themselves, pressures from the brokers. As a side note, we also saw a huge CDL school and training program surge this year so far. You're looking at nearly 7,000 CDL training programs in schools that have been shut down or removed. This is one of the largest ones. At the end of 2025, the FMCSA had said it had about 3,000 that was removed. Year to date so far, you're looking at almost 10,000 removed, which gives you that difference of about 7,000 schools that have been removed. The FMCSA is not playing, so you shouldn't either, right? Compliance is no longer something that you think you might want to consider. Because what does this mean? You're looking at the human consequence right now, right? The vetting for carriers, for truckers, for drivers, owner operators, the vetting bar, the standard is getting higher, guys. All right. So brokers now, because of the CDL school purging, brokers are now being advised to audit any new entrant against what school were they trained at, right? It's not a requirement, but it's certainly something that's being encouraged. Take a look at these guys that are coming out. Where have they been trained? Are they coming in from one of these schools that have been put in that list? A bad carrier, like we mentioned, exposes now the broker to state court liability. Not just a bad load. It's not just, they didn't get my load on time. Now it could potentially get the broker sued themselves. So what does that mean? It means brokers are being much more cautious about who they give it to, right? Who they give these loads to. And unfortunately, new entrants, where you don't have a safety score, where you are coming out kind of fresh, they're not necessarily going to be the first pick of the batch from these brokers. So if you're a new authority or you're a small fleet without a pretty good record, you're now competing against those guys that have been taking it seriously, that have been here for a long time, that have established that broker relationships. You're not going to be competing with them. So even though spot rates are great, they're taking a look at something more than just the fact that you can drive a truck. They're taking a look at your safety score. They're taking a look at how long your longevity in this industry, okay? Getting booked is kind of becoming about just as hard as finding that load. Another potentially important thing to kind of take a look at is the cargo theft. So yes, year over year, cargo theft in terms of count of losses has gone down about 26%. but the pardon me, and actual incidence has gone down, but losses has gone up three 304 million. It doesn't mean that the criminals are going down. It means they're getting a lot smarter and pickier about what they're deciding to choose. And now in this digital age, we advise all of our carriers, be very cautious. It's no longer now just the guys coming in and physically taking things from your truck. It's the guys who are pretty good behind a keyboard, taking a look at your email, being able to take a look at shipment and sending shipment routes to a different way. So it's also now on the digital side, on the technology side, where cargo theft and cyber criminals are also kind of getting involved here. What does the carrier think? Okay, so what's the sentiment? What's going on? It's sort of a mixed bag, and it kind of varies between the small fleets and larger fleets. Okay, so if you're a small fleet here watching, you could probably kind of have some similar sentiments to what we're about to share, right? So 97% of account managers say that cash flow is still the biggest problem. So yeah, spot rates are up once again, but again, so is diesel. Your operating costs are up now, right? An interesting fact that we heard from one of our carriers when we talked about buying new trucks, he said, well, not really going to buy a new truck right now because even those new trucks with the new tariff inflated numbers are pretty high. So you're still looking at the older trucks that you're going to look at, make sure they're reliable, because once again, maintenance, preventive maintenance is still very important for your score, and your score is now important more than ever. Okay. So cash flow is still the number one issue going on with carriers. And I think that that's probably across the board, not just for small fleets. When you take a look and you've asked carriers, and I forget to cite this particular survey, I want to say it was FreightWaves, there's a 26% optimistic return versus the 53% concern. So roughly about a quarter of fleets right now are saying that they're still cautiously optimistic about what's going on in the market. While they are happy about the rates, they're not necessarily going out there and buying new trucks right away. I think some of them, well, I think we know that a lot of them are just kind of sitting back and seeing what's going on. This has kind of been a roller coaster every year where you get started really well, the war happens, and then you think diesel prices is going to be a little crazy, but then these spot rates come up, but then demand isn't really there, but demand is kind of starting now in August. So it's a bit of a roller coaster here for our carriers. Overall, though, the FTR TCI came out at 20.4 as a quick reference. This is kind of the trucking market's credit score, right? So anything in the negatives, not great. Anything over zero is good. Anything in the double digits, even better. So the 20.4 that's coming out, that reading came out in May, pointing to a pretty good credit score on our trucking industry right now, on the market right now. What does that 20.4 take into account? It takes into account your freight volumes, your freight rates, your fuel prices, your financing costs, and your fuel utilization. Are you utilizing? How much are you utilizing your truck? So it takes those 5 categories into account to be able to give you this credit score. And so far, it's looking okay. All right. But who is this mostly affecting? A lot of this is mostly affecting the smaller fleets. All right. So even though the net revocations, like we talked about earlier, the exits are kind of down year over year because people are probably wanting to stay to kind of see how this plays out. Smaller operators are being squeezed by the fuel costs, the rising fuel costs, and those insurance spikes. All right. Bankruptcies as well haven't stopped. There was a certain period here over the last 30 days where about 20 bankruptcies took place. So it's still a real thing. People are still exiting. And again, it's mostly concentrated in the small carriers. If you take one thing, okay, guys, the carriers who make it through the next 6 months are not the ones who are catching the best rate, like we just talked about. They're the ones who fix their cash flow discipline. They're the ones who are taking a look at their preventive maintenance. They're taking a look at their safety score and taking it very seriously. Okay, the freight is coming. Peak season is coming. It's like we talked about. The PMI is up. The tonnage is up. We're starting to see early demand here in the back to school days. So we know peak season or demand is going to start to rise. But so are 90-day payment terms, insurance renewals, and you've got your brokers taking a look at that safety score like Santa, checking it twice. All right. So make sure that you are those carriers that makes it to the next 6 months by being disciplined and taking a look at what's going on with your operations. So real talk, we've said a lot. What does all of this mean, right? So what are the actual concrete things that we need to be taking a look at over the next couple of months to see if this market is going to be sustainable, if this is a temporary blip, if demand truly is coming back? Let's take a look at tender rejections, okay? September, October, again, your peak months there. If we start to see that front loading that we talked about with the inventories, it might be confirming that demand that is in fact coming up, that tightening might be demand and not just supply side driven. You've got your safety score, your training documentation. We don't say this just because we're a compliance company, but we have been preaching it. Your safety score and your training documentation have everything. Something as simple as having your clean binder in your truck with all of the information. It might not be digital, but organize yourself. That could save you in a stop. Make sure your truck is clean. You're taking a look at those headlights. You're doing your pre-trip and your post-trip, right? It's not just something voluntary. It never was, but it's not just something that you can just ignore now and think, it's fine. This is how you get your loads. This is how you stay in the market, how you stay sustainable, okay? And again, your cash flow. Cash flow is always going to be a problem. We know this, right? We're never going to be happy with the amount of cash flow that's coming in, and we shouldn't. That's what helps us chase the higher spot rates. Now, build the reserve where we can. Spot rates are up, and if you're one of those brokers that are getting chosen for loads, reserve it. Make sure that you're taking a look, especially for those smaller brokers out here. What is your break-even cost? Are you planning the right way, right? Don't just take a look at spot rates and say, all right, this load is going to cost me this. This is about my fuel cost, and that's it. In fact, Adam Wingfield, shout out to him, has a really good way, and we're going to talk about that in the next slide, of taking a look at your operational costs that could help you a little bit more on your per week diagnosis of your cash flow. So the trucks that left the market this year are not coming back. A lot of it due to regulation, right? So a lot of them, they can't come back. And it isn't because the freight has disappeared. It's because the bar to stay in this business has permanently gone higher. You've got your Supreme Court, you've got your litigation, you've got your legal issues, the insurance pressures that are coming in. All right, you've got the ELD, you've got the English proficiency, you've got the non-domiciled CDLs, you've got the CDL training programs. That is all squeezing the market. Okay, some say much needed. And so peak season hits this October. Make sure that you're ready for it. A bonus takeaway, like I just mentioned, we can't take credit for this. This is something that Adam Wingfield, who's a big name in the industry, kind of talks about a little bit more. So if you are a new carrier here in the industry, point him your way. So know your true break-even cost. Make sure that you're taking a look at what your variable costs are, and what your fixed costs are. So what's a variable cost? Your variable cost is your things that run with your truck. You've got your fuel, your maintenance, your tires. You've taken a look at your tolls. Sometimes some folks kind of do ignore that. And you've got your fixed costs. This is what hits you either way. Whether your truck is moving or not, you've got your fixed costs. You've got to pay that insurance premium. You've got to pay that truck. You've got to pay your IRP. You've got to pay those permits. These are your fixed costs. You should still take these into consideration. Even if they happen once a year, divide them. Make sure you're taking your monthly fixed costs, divide them by your operating days, and you've got your cost per day. You should be adding in your variable cost per mile to kind of get a better, truer weekly break-even number. That should help you when you take a look at your loads and your spot rates and what something's going to cost you. That should be able to help you a little bit more in deciding how to negotiate, if you should reject it or not, or if you should just take it. So a lot was said here, right? But once again, we're going to end on, once again, for the people in the back, we're going to end on something very, very important here. We've talked a lot of talked a lot of data, talked a lot of regulation. Once again, the carriers who are going to make it not just the next 6 months, next year, who are going to take advantage, especially those in flatbed, who are going to take advantage of what's going on with those particular sectors where demand really is going to be booming. Okay, are the guys who are taking themselves seriously, are the guys who are checking their safety score, who are taking a look at their trends, who are taking a look at their vetting their drivers, who's helping them carry that load, who's taking a look at the discipline of their cash flow. Peak season is coming. It is coming. It should be a pretty good one. But again, you've got other stuff on the other side of the coin here. You've got the brokers taking a look at you. You've got your payment terms now going up a little bit. We've been hearing that it's no more net 30 and 60. It's looking like net 60 and 90. Okay, so that hurts. Take a look at your cash flow, your financial records, and make sure once again that you're watching out for your truck, watching out for yourself, making sure you've got all of your things in order. Should help you take advantage of, even if it's supply side driven, of the supply side driven demand that's happening in our industry right now. All right. So if that was a lot, it seemed like a lot, we're going to be able to have some of this information available for you on our website. Additionally, if you want to rewatch some of the stuff, where this video is going to be available on YouTube, make sure to follow us at Simplex Group across all these social medias. And we look forward to hearing from you guys. Whatever you guys need, simplexgroup.net, and we are here to help out however you may need us. Thanks so much for watching, and have a great day.